Nalco's June 2020 quarter earnings were above the street estimates. Lower cost in the aluminium segment and also the inventory gains definitely helped Nalco post better results this time. In our ideas for profit today, we'll discuss if this stock warrants investors' attention for the long term. Let's look at the earnings first. Now, revenues were lower by 29% and that's on a quarter-on-quarter basis, and that was on the back of the lower prices as demand was impacted for both alumina and aluminium. Now, gross margins improved to 63% as compared to 54% in March 2020 quarter, and that was due to the low prices of coal and carbon. Now, employee cost also remained flattish and other expenses were lower by 35% on a quarter-on-quarter basis, and that was on account of the decreased volumes and the lower manufacturing activities as well. Now, EBITDA was down by 38% and that's on a quarter-on-quarter basis as well, and that's due to lower sales and negative operating leverage. Now, during Q1, Nalco booked inventory gains of 448 crore rupees. Now, other income was down by 69% on a quarter-on-quarter basis as a result of the reduced cash and cash equivalent. Now, because of the lower EBITDA and the other income, the profit before and profit after tax were down by say 86% and 84% on a quarter-on-quarter basis respectively. Now, lower LME prices for both alumina and aluminium segment impacted the revenues this time. Aluminium segment reported positive EBIT after 4 quarters, that is, and that was on the back of the lower raw material prices. Now, Nalco was also granted lease order for the Utkal D coal block with initial capacity of 2 million tons per year, with a total mineable reserve of 101.68 million tons. Now, Utkal coal block was allocated to Nalco in May of 2016. Now, we also expect Utkal E block, which was allotted to it given the grant of the mining lease. Now, with both these coal blocks in place, coal for the captive power plant will be mostly secured now. Now, Nalco has started building 1 million ton per annum of alumina refinery along with the further investment in Utkal coal blocks and other joint venture products as well. Now, total capacity or the capital expenditure that's along with the including maintenance capex is likely to be about 5,500 crore rupees between FY21 to FY23. Now, with the expected cash flows from operations, existing cash balances, we do expect Nalco to raise debts for the funding of the projects or above the projects from say FY23 onwards. Now, on the back of the higher capex, we also expect reduced dividend per share to be maintained for FY21 at a similar level to FY20. Now, for FY20, the company had declared a 1.5 rupee per share kind of a dividend. Nalco, with the integrated setup, lowest cost curve in terms of the alumina production and captive power supply, is also likely to remain quite competitive going forward from here on. Now, also, if you look at Nalco has never reported an EBITDA loss before, and alumina and aluminium have both recovered from the lows seen in the March and April months. However, given the lower economic growth and the lower industrial activities right now, the supplies are likely to exceed the demand of calendar year 20, and the prices of alumina and aluminium is likely to remain under pressure even going forward from here. Now, with Nalco getting allocation of coal blocks, power costs are likely to reduce going forward as Nalco stops purchasing from the grid for its requirement. So, we do expect a gradual recovery from FY22 onwards. Nalco is trading at a PE of 19.5 times and 6.7 times EV to EBITDA based on FY22 expected earnings, and investors with only moderate return expectations can actually look at this stock for a gradual accumulation for the long term for sure.